Okay, so we're going to get started on Chapter 8. In Chapter 8, we have these 10 sections. Today, we're going to go over the first 4, which are just kind of the introductory parts of the chapter. And then Monday, we're going to go over number 5, which is cost flow assumptions, which will be LIFO, FIFO, etc. And that'll be kind of more or less the meat of the chapter. And then Wednesday, we're going to go over 6, 7, and the rest of that, which in the main part of that is dollar value LIFO and the LIFO reserve. So that'll be something new that you haven't really done before, dollar value LIFO and LIFO reserve, and that's really kind of the hardest part of the chapter, okay? But in this first part that we're going to do, 1 through 4, there's some journal entries and some kind of, it's more of a classification thing. Where do things go on the balance sheet and what kind of journal entries do you make? And then number 5, there's a lot of stuff in there, but it's stuff that you've had before, okay? So starting out with inventory, let's just think about what inventory is. Where does inventory go on the balance sheet? Yep, okay. So it goes in current assets, all right? So inventory is stuff that you're going to use in your business, that you're going to sell in your business, okay? So you could either be, your business could be a merchandise business or a manufacturing business. So what's an example of a merchandiser? Walmart. And then a manufacturer would be, you're on a roll. Did they make their own paint? Okay, then you're just going with what they, so Sherwin-Williams, I guess, maybe they make their own paint, huh? All right, so the difference is whether you make your own product. Walmart does not make its own product, right? It buys stuff from other people and resells it, okay? For a merchandiser like Walmart, a good example, the only kind of inventory they have is just one kind of inventory, the thing that they bought, okay? So they keep it, okay, let's just review. They're keeping it as an asset on the balance sheet until they sell it, at which time it will go to the actual, it'll go to the income statement in, not as a revenue, but as cost of goods sold. The inventory goes directly to cost of goods sold. So the cost of the item stays as an asset until it's sold, at which time that cost goes to the balance sheet as cost of goods sold, because that is kind of matching the sale, the revenue from the sale with the cost, putting it in the right period, putting it in the same period. Okay. But a manufacturer, like apparently Sherwin-Williams, makes their own product, and they have several different accounts of inventory. Okay, so when they first start making their paint, they're buying chemicals and colors and whatever it takes to make paint. Where does that stuff go? Raw materials. So all the raw materials used to make paint go in an account called raw materials, and then when they start actually making the paint, all the stuff that they pull out of raw materials and start making the paint with goes into work in process. So there's another inventory account called work in process. Then all the time they're making the paint, it stays in work in process until which time the paint is finished, which I wouldn't imagine takes too long to make paint, would you think? When that process is finished, it goes into finished goods, and it sits right there. Okay, so those 3 inventory accounts, see how they're separated, hypothetically, on the balance sheet. They lump 2 of them together, right? But usually you separate these 3 accounts on the balance sheet. Maybe since it's paint and it doesn't stay in work in process so long, they lumped it in there. Okay. So the inventory is an asset. All of this stuff that they buy to make the paint stays in there in the inventory account as a current asset. See, it's in current assets until which time the paint is sold, and then it goes to the inventory. Then it goes to the income statement in cost of goods sold. Okay? All right, so this is just kind of showing that same thing over again, that we have raw materials, work in process, and finished goods. See those three kinds of accounts. Now, the raw materials is also combined with labor and overhead sometimes. So it's raw materials, direct labor, manufacturing overhead is combined, is put in work in process. Okay? All right. So now this is very important here, this little picture. Okay? Because it gives you a formula that we're going to use a lot in this chapter. Or this gives you the kind of thing that you have to understand in this chapter. Now, does this look like a formula? The picture there, Jeremy? No. Okay. Can you make a formula out of it for me? So those two things at the top, what happens to them? They go to that box in the middle, right? Okay, so how it goes is beginning inventory, one of the things at the top, plus purchases equals what, Jeremy? Cost of goods available for sale. Okay, so cost of goods, or let's just call it this, goods available for sale. Okay, so to review, how many goods could we sell all year long? We can only sell the goods we have available, right? Okay, which is the stuff we had at the beginning of the year, the beginning inventory, plus whatever we purchased during the year. So like if we're Walmart, we can sell no more than ever got to our store and was put on the shelf, right? Which was the stuff that was there at the beginning of the period, plus the stuff that we purchased and brought in. That's all we could sell that year. That's our max, okay? So this is our goods available for sale. So now, all of those goods that were available for sale, what could have happened to those goods, Avery, on the picture? They got sold, in which case they would go in. If they got sold, they would go into goods that are sold, when they're sold, come out of inventory and go to cost of goods sold. Okay, so they can either go to cost of goods sold, see there on the bottom? These are the goods that were sold. Or they could do what? What's our other option? Yes, in the inventory. And what happened to these goods? They were not sold, right? All right, so here's our formula. You see the formula now, Jeremy? You got it? Those two things at the top added together equals goods available for sale, and they are, we could subtract, we could take the goods available for sale minus cost of goods sold equals ending inventory. Now, the other thing we could do is we could say goods available minus ending inventory equals cost of goods sold. Okay, do you see how that would work either way? But the main thing you need to know is these two things added together are goods available for sale, and these two things added together are goods available for sale. So you can either figure out ending inventory if you can figure out cost of goods sold. More importantly, if you know goods available for sale and you know ending inventory, then you know what cost of goods sold is, right? Cost of goods sold is goods available for sale minus ending inventory. Okay. So we're straight on that one? Questions about that? Okay. So that's something you should this one we're going to memorize, right? Going to know this one because this is very important for a lot of reasons. Now, you can keep track of your inventory methods, your inventory. You can keep track of your inventory as it goes through your system. If you're Walmart, let's say, or if you're Sherwin-Williams, you can keep track of your inventory in your accounting system in two different ways. Okay, one is the perpetual system and one is periodic. Okay, so let's just say, what do these two things mean in general? Periodic. Every once in a while you do something, right? Periodically you do something. Perpetual. You're doing it all the time, right? So what are we talking about here? Under the perpetual system, every time we buy or sell goods, we make an entry, a journal entry to what? In red. Inventory, right? Every time we buy or sell goods, our journal entry goes to inventory. What does that mean? Our inventory is perpetually up to date. You know? So it's like we know at all times how much is in our inventory because when we buy something, we make an entry to inventory. When we sell something, we make an entry to inventory. And whenever stuff happens with our inventory, we're keeping it up to date. What does that mean? Like when I go to Walmart, I'm pretty sure they're under the perpetual system, and I buy something, they take that item out of inventory, right? The store's inventory, they remove it from the store's inventory right then. They record the sale, you know, how much I paid for it, and they record the fact that it's taken out of inventory, and they put it in cost of goods sold. Okay, so this is the perpetual system. Or the other way we could do something is periodic. What does that mean? Every once in a while we do something. Periodically, we do something. What do we do under the periodic system? Every once in a while we count our inventory and see how much is there. This is the only way we know how much is there in our inventory under the periodic system. We go count it. How many things of toothpaste do we have? We have to go count, right? Under the perpetual system, do we know how many things of toothpaste we have? Yes, at all times. Like you can go to Books A Million, which I do sometimes, and ask them, do they have a certain book? Oh yes, we have 2 of them, right? They know. It's just up to you to find them somewhere. It's just almost impossible sometimes. Well, what shelf? Oh, it should be over here, you know, in this general area. So, but they know under the perpetual system. Under the periodic system, well, we don't really know. We don't keep track of our inventory, right? Okay, so under the periodic system, the ending inventory is determined by a physical count. So what happens? They just go out there and count it every once a year, twice a year. They figure out the inventory amount. They know these numbers, purchases and stuff like that, and then they figure out the ending inventory, and then they know what cost of goods sold is. So they don't know inventory or really cost of goods sold either until the end of the period in the periodic method. Okay? So how do they figure it out? Beginning inventory plus purchases, they count the inventory, subtract it, and then they know their cost of goods sold was $775,000. Okay. Well, so now they want us to do this. Here's all these transactions. They want us to record it using the perpetual and periodic, which we would just skip kind of, oops. Oh. Yes, we're gonna watch them do it, okay? We're gonna watch them record this. So under the perpetual system, remember, when we purchase something, it goes into inventory, right? Where does it go under the periodic system? Do y'all know? What's that? Not under the periodic, because we don't know what's in inventory. We don't keep track of it that way. When we get there, we'll see where it goes. So every time under the perpetual system, all these entries are going to go to inventory. So we purchase something, it goes to inventory. We sell something, and in addition to the sales revenue, we also record that we're taking it out of inventory. Into inventory, out of inventory. So notice on a sale, under the perpetual system, we have two entries for a sale. One entry to record the sale, and the other entry to take it out of inventory, okay? When we take it out of inventory, we put in cost of goods sold. All right, and then at the end of the period, we go and count our inventory, right? We already know what's in there, right? Yes?
Why did they do 600 at $12 instead of at $6?
We sold it for $12. We sold it for $12, but the cost was $6.
Oh.
Yeah. So the customer paid us $12. Yeah. Yeah, so you're right. The amount of the sale is going to be different than the amount of the cost. What's these guys' gross profit? $6 a unit, yeah. So what's their gross profit ratio? You got this one. It's the gross profit divided by sales, right? 6 divided by 12. 50%, yeah. Okay, so you see where we're going? The gross profit is sales minus cost. Okay, all right. So looks like they just flat double their cost to get their sales price, right? Which that's what a lot of people do. All right, now we're going, Jonathan, you're going to recover, right? What is our entry under the periodic method when we buy something? This would be a wild guess. You haven't recovered?
Yeah, I don't know.
Okay. All right, we put it in purchases. Okay, so we put it in this account called purchases. All right, not inventory. Different, right? We put it in an account called purchase. All of our purchases go in the purchases account, right? Then when we sell something, what kind of entry do we have when we sell something, Angela? Well, yeah, that like that. We sold it for $12, so accounts receivable and sales revenue, we record the sale. Then what do we do with our inventory? Nothing, okay? See, no entries are going to inventory under the periodic system. We're not making entries to inventory, right? When is the only time we make an entry to inventory in the periodic system? At the end when we count it. Then we're going to make an entry to inventory, and what are we going to do? We're going to adjust our inventory to the correct amount. What is the correct amount? At the end of the period, we have 400 units at $6, so our correct amount is 2,400, right? And at the beginning, we had 100 units at $6, so we had 600 at the beginning, 2,400 at the end. So now we know whether we need to debit or credit inventory, right? We need to increase inventory up to 2,400 with, this is the way they've done that. Put in the ending, take out the beginning. That's what they did. put in the ending, take out the beginning. You could have just made an entry for 1,800, right? But they chose to do it that way. And then they record the cost of goods sold, and they take out the purchases, and then the cost of goods sold is what's left over, right? All right, so in this situation, let's just plug in these numbers here. Our beginning inventory was how much? 600. Our purchases were 5,400, right? For a total of 6,000 available for sale. We could have sold $6,000 worth of stuff, right? But how much? What we did was we had cost of goods sold was 3,600 and ending inventory was 2,400, right? So that's kind of our formula for this one.
So say we had sold all 900 purchases and then sold even more than that, we would just end up with the purchases account having a credit balance?
No, where our purchases account is wiped out. At the end of the period, we wipe out our purchases account. So whatever we had in purchases, we take it out so that this becomes a plug number. So if we sold, our purchases credit is going to be whatever the total is in purchases. Okay? At the end of the period, we wipe out. It's kind of like a income statement kind of account that's wiped out at the end of every period.
Say we sold all 900 though.
Okay.
And then you want to sell more, but all you have is left is whatever's left in inventory, not purchases. Would you still debit or credit purchases?
If we, okay.
Out at the end of the accounting period?
All right. So, okay, now I'm getting what you're saying. You're saying we sold the things we purchased and we still had some beginning inventory left there?
And we try to sell that.
And you can sell that. Yeah, you can sell that. So what if we sold all our purchases and you're saying, okay, now let me get what you're saying. We had 600, we bought 5,400, so we had 6,000 available for sale. What if we sold all of our purchases, which is 5,400? Then we would have 600 left. But you're saying, what if we wanted to sell more than, what if we were able to sell more than 5,400? What if we sold 5,800? Right? Then you have 200 left, and that's your ending inventory amount. Am I getting to what you're thinking?
I think so. I see what.
Yeah. So you could sell more. Yeah. You can sell as much of that as you want to. You just can't sell more than 6,000.
And just at the end, the inventory ending would just be 0.
Yeah, if you sold it all, it'd be 0. Right. Now, the thing is, under the periodic method, you're going to go and count your inventory, and you're going to know exactly what your inventory is, right? So you can get your cost of goods sold exactly right. Do you count your inventory under the perpetual system? Yeah, they already know what the inventory is. And you've never seen Walmart count the inventory, right? Anybody ever worked at Walmart? Anybody work anywhere where like Walmart? No. Y'all hadn't never seen Walmart count the inventory. What about the grocery store?
I've seen Walmart use their
Those scanners, right? They do count the inventory. They do count the inventory. Why do they count the inventory?
Do they just do the double check, like someone steals stuff?
Exactly. You know what? At that book place, sometimes they say there's 2 books on the shelf, but it's not there. You can look forever, and it's not there. Why? What could have happened? Yeah, somebody could have stolen it, or it could have just been a mistake. Somebody rang something up wrong or whatever, and then there's all these problems. So yes, you need to count it under both systems, periodic and perpetual, because it's a double check thing for the perpetual system. Well, as a matter of fact, it would be a rare day that you went and counted your inventory and it matched exactly to what you thought it was. You know? For sure, there's probably some mistakes or whatever. Okay, so there we go.
How would you adjust to that?
Yeah, how would you adjust to that? I'm thinking they might show us, yes, that's a good question, actually. So assuming that we thought we had $4,000 in inventory, but instead our physical count is 3,800. So in other words, our account now has $4,000, our account in our books says $4,000. We want to adjust it to 3,800. What are we going to do? Debit or credit? Credit inventory and debit something. That's what you want to know, right? That's the thing you want to know. We have an account called over and short, okay? Now, there's an over and short account that we have for inventory, and there's one for petty cash. What does this over and short mean? This accounts for any mistakes or any kind of theft even, you know. So, this thing is a debit right now, right? This is a debit. Something like, let's just say what happened to this stuff. We have $200 worth missing in some way. So let's say it walked out the door, the inventory walked out the door, then what is this? An expense for us, right? It's a debit. This is like shrinkage, theft expense, shrinkage expense, mistake expense kind of thing. So it can go in other revenues and gains or other expenses and losses, but most likely it's usually going to be a debit because inventory doesn't usually walk in the door. You know, it's usually kind of missing, more missing than found. Okay. And the reason that we put it in a separate account, you could just throw it in cost of goods sold, like, well, that's just the cost of doing business. But it's best to separate it out so that management can keep track of how much is in that number, right? Okay, so everybody, see how we've got that highlighted? All companies need to count their inventory. All companies need to count their inventory to, you know, just to make sure everything is fine and count and compare it with the detailed records. Okay, near the end of the year. So, I mean, you could count it on December 31st, right? If nobody wanted to take New Year's Eve off, right? But so, or you could count it near the end of the year, you know, just to sometime. Usually, if you're a company that does a lot of business in December, you might, you know, count it a little bit after January, the first week in January or something. Okay, so then you adjust your records to that amount that you counted. Oh, this is all the thing about using the scanners. Yeah, they're saying that what they're talking about is they purchase something when they need it. I don't know if in management, if y'all have talked about just-in-time inventory systems. Because inventory is a huge amount for a company like Walmart, right? So the way they do things is that they kind of, whenever I go buy, okay, this is what happened to me at Target. I went to Target to get bookcases. I wanted 4 bookcases, tall bookcases like this, 4 of them. And they were like $250 a piece. They were tall. They took up a lot of shelf space. How many did Target have? 3. Not enough. So I go to them when I'm buying them and I say, look, I wanted 4 of these, but you only have 3. This is my problem at Target a lot. They usually only keep 3 of something. You know, they don't keep a lot on hand. You know, And they told me that, yes, when you buy these, then that automatically puts in an order for 3 more, and they're going to be here on Thursday. They already know this. They know when the next ones are going to be there. They know how many are coming in and such as that. Well, I forgot about that or didn't have time or something. Now I have 3 bookcases in my space where I should have had 4. You know, I'm just got this blank place. But the point is, Target orders stuff that they automatically know it's going to come in a truck just in time, which means only when they need it. So it's going to come like 2 days later, automatically. And so that's a good inventory system because they don't have too much stuff there. They don't have their money tied up in inventory, right? So that's what those scanners are good for. They're not just charging you, they're also reordering stuff, you know, based on what you ordered. They wait until stuff like that where they only have 3, they're just going to automatically reorder it. But with other stuff, they wait until it gets down to a certain level and then they reorder. They've got automatic systems in there to reorder as they need to. All right, so that helps make them efficient and use their money efficiently and improves their bottom line. Okay. This is the same stuff we've been doing. How does this formula work? So here's another example of this formula. We have all these goods available for sale, and we can either sell the goods or not sell the goods, right? These are our only 2 choices. So cost of goods sold and ending inventory is derived from that goods available for sale number. Okay, so now we're kind of done with that part of that section of the chapter, and we're going to talk about inventory valuation issues. What do we mean by that? Okay, so there's 3 parts to this. The physical goods part, which that means, is it our inventory? Is it our inventory? Okay, when does it become our inventory? Well, does that seem clear enough? All the stuff in the store is your inventory? Does that seem clear enough? Yeah, but there's some other things. Yeah, there's some things we have to consider. And then what costs are included in inventory and what cost flow assumption to use. So like I said, we're not really getting into that cost flow assumption part today. We're doing those top 2. Okay, so now we are wondering, is it our inventory? Okay, so these are a lot of different situations. Too bad we don't have a lot of slides on these. We just have this one slide to help us with, is it our inventory? So these are the unusual situations. So FOB shipping point. What does that mean, FOB shipping point? We're on page 421. 421. What does FOB mean? Free on board. Okay. All right. So the situation is whenever Walmart orders stuff, let's say, it says, I want to buy some of your stuff. I want to buy some of your stuff. We put it all on a truck and we send it to Walmart. Okay, so this is us here. And we put our stuff on a truck that we send to Walmart. Where are the goods? The goods are on the truck, right? Okay, who owns the goods? Kyle, see, they're not in our store. They're not in Walmart's store. We don't know whose they are, right? How do we tell? So it's considered sold when the title passes, okay? So now, surely, yes, we have rules for this. when these goods become ours. Our two options are FOB shipping point and FOB destination. Okay? So what does this mean? If under an FOB shipping point, the goods are shipped from here to here. This is the shipping point, and this is the destination, right? Okay, so under FOB shipping point, the title passes according to the FOB. So if it's FOB shipping point, the title passes at the shipping point. If it's FOB destination, the title passes at the destination. Okay, so what do we mean by that? If it's FOB shipping point, the title passes here. Okay, so when the title passes, what does that mean? The goods are sold because it's considered sold when the title passes. And the inventory changes hands. Inventory, I mean, literally, it's not ours anymore. The title passes, it's not ours, it's considered sold. So when it's sold, it's going to go to cost of goods sold, and we're going to take it out of inventory, right? So if an FOB shipping point, whose goods are these? Whose goods are these? Walmart's. An FOB destination, whose goods are these? Ours. Okay, so these goods that are in transit are Walmart's goods if it's FOB shipping point. They were our goods if it's FOB destination. Okay? Now there's a lot of ways to get mixed up on this one, you know, because the problem can say it a whole lot of different ways to confuse you a little bit. But what I think is the easiest way to picture is this truck and this building and all that, and to know that the title passes and the sale occurs with the FOB. Did you have a question?
What if it gets lost in transit?
Okay, that is a good question. Okay, so let me tell you a story about that. My husband's a judge, right? And so the sheriff called him up one day and said, if you're in the area, maybe go through Sasser because a truck of cantaloupes turned over. Okay? And they're all over the road. Okay? So that's kind of an example of getting lost on the way, right? You just turned over and okay, the people that own the cantaloupes, what are they not going to do? Send another truck and pick up every single cantaloupe, right? It's just not worth the trouble. So it was just a free-for-all with cantaloupes. Everybody you knew was going to go get cantaloupes. Now, what you want to know is who is crying over the spilt cantaloupes, right? Because also with the FOB is the risk of loss. When the goods are on the truck like that, there's insurance. It's insured. And somebody has to pay for the insurance. The people paying for the insurance are the people that own the goods in general. And because they're the ones that have the risk of loss. So depending on what the FOB is, that determines whose goods they are and who is going to buy the insurance and who's going to have a loss. So the cantaloupes were insured, so I did not feel bad about eating the cantaloupes, right? And so it wasn't like anybody was crying too bad because they had the insurance for it, except maybe the trucking company who had a turned over truck, okay? So that answers that.
So if it's the shipping point, then Walmart would be.
Yes, Walmart would buy the insurance and they'd be crying, or
But
hypothetically.
we would if they didn't receive it.
Right. Okay. So now the next one, consignment goods. Yeah, like I say, I'm sorry we're not going through slides because it's really better when you have these pictures to go with. But in consignment goods, how many of y'all have any idea what a consignment good is? Yeah? No? Consignment? Strange word, right? So what that means is this is what I did 10 years ago. I made homemade soap, okay? Have you seen where you can buy little slices of soap for like $6? So I sold my little slices of soap for $6. And I went to people's stores and I said, do you want to buy my soap and resell it? They said, no. But I tell you what, we'll put your soap in the store, and if somebody wants to buy it, then we'll keep some for ourselves. Like they kept $1 and gave me $5, right? So what do we call that? What do we call that? Consignment. That's what we call that. Who owned that soap? I do. Who didn't own the soap? They didn't. They didn't pay for it. All they're doing is getting $1 for every slice they sell. So Kyle, if somebody would go do inventory in that store and saw a bunch of soap sitting out that was my soap, whose soap is it? Mine. Is it included in the store's inventory? No. Okay, so that's the deal. Consignment goods are the sellers, which is me trying to sell the soap, not the buyers, which is the store. And they just get a percentage. So it's not their inventory, ever, okay? It's not ever their inventory, it's my inventory, okay? Now, sales with buybacks. Now, this is a weird situation where a company might say, here, let me sell this to you, and I promise to buy it back on January 15th. Let me sell you this big stack of stuff, and you buy it, and I'll buy it back on January 15th. Angela, how does that sound to you? Yeah, what's the point, right? What's the point of that? Why would you say to somebody, will you buy my stuff and then I'll buy it back January 15th? Pretending you're a business owner who is going to have an income statement on December 31st, right? If you sell a bunch of stuff, then it's going to go in sales, right? And then when we buy it back January 15th, well, we just won't worry. That'll be next year's problem, right? So do you see what's happening? They're trying to fake a sale. That doesn't sound like a sale, does it? No, because it's a buyback agreement, okay? So there's no sale in that point. That's why we're saying no sale, because all we're trying to do is pump up our sales, okay? So in other words, that's kind of fraud almost, right? We're creating a sale that's not really a sale. So that's not, the problem is it's kind of hard to find the fact that there's a buyback agreement. You know, if you're the auditor or whoever looking at the financial statements, how do you know that there is a buyback agreement? So, you know, this is a little bit difficult to find. But at any rate, this is no sale. All right, now let's look at the next case. Sales with high rates of return. What are we talking about here? A lot of people buy the stuff and then a lot of times they bring it back. So I think Jonathan might have read in the book a little bit. The example of this, do you recall? No, okay, is a situation where people buy back a lot of the stuff is in the bookstore, okay? A lot of times, well, this is with magazines. I've seen this before, where magazines come out once a month. Okay, let's say a certain magazine comes out once a month, once a week. People magazine, let's say, once a week. They deliver a whole pile of People magazines, and then whatever they don't sell, People takes them back. Why is that? Have you ever seen that? They take out all the old Peoples and put in the new Peoples. Have you seen that happen? Maybe not. Maybe you're not watching the magazine racks like I am. But this happens every week, right? And what do they do with those old Peoples? They really just give them back to People or throw them in the trash. But People or books, the bookstore here, sends stuff back. if there's not as many intermediate accounting books sold as they expected, they send them back like after drop ad. Okay? Why is that? They don't want a whole pile of intermediate books sitting on the shelf. And the companies agreed to buy them back. Now, come spring semester, they'll put some more back on the shelf. See how it goes? It's just you're shipping them back. But the company, the book company, wants you to have enough to sell, and they've agreed to take them back as returns. These are returns. When the bookstore sends them back to the company, it's a return. So they've agreed to that because they, want to have the possibility of making the sale. Now the thing is, sometimes with the bookstore here, I imagine they know what percent they're going to return. Okay, the question here is, when the bookstore buys books from Wiley, who's our publisher, right? When the bookstore buys the books from Wiley, does Wiley record a sale knowing that a whole ton of them are going to be returned? That's the question, right? We're looking at it from Wiley's perspective. Do they consider those books sold? Only if they can estimate the returns. And what would be the case there? If they've done this year after year and they know, well, about 20% of these are coming back, they can go ahead and count the sale and count the returns so that it will net out. Okay? All right, so the next one, sales on installment. Okay. A lot of furniture stores sell stuff on the installment basis. So where you can pay, like my son did this, bought a couch, a chair, and an ottoman, and paid $100 a month. Right? So, is that a sale? The question is that a sale? Well, what's the problem here? The problem is sales made on installment, it's much less. When I go buy furniture, normally I just pay for the whole thing, unless it's 0% interest, and then sometimes I spread it out, but usually I just pay for the whole thing. So a sale like that, they know they're getting their money. My son's way, $100 a month, he might get tired paying about month 8 or something, let's say. And then then they have to come haul it back away. See, these installment sales are a little bit more risky, right? Would you agree? They're a little bit more risky because these are with people that may not have all the money to pay for it. That's why they're paying only $100 a month. So if they somehow lose their job or whatever, then these are riskier. So the only way you can count an installment sale like this is a sale if you can estimate what your collectability is and go ahead and record bad debts and stuff. Okay? All right. We have, oh man, we've got a lot left. Okay, let's finish this part and then do some problems, okay? I definitely want to get to this part. This is super important here too. And this is like one of the most favorite CPA exam questions right here. What happens if one account is overstated or understated? How does that affect something else? Okay, so you've got this little picture on page 424. Okay, so we have this picture, and then we have another one similar to it. See this picture, 2 pictures. The first one is where your ending inventory is misstated. Okay, so why would our ending inventory be misstated? We went out and counted it, right? But what happens if we counted it wrong and we have entered the wrong amount into ending inventory? Okay, so here's our formula, goods available for sale, and we subtract ending inventory to get cost of goods sold, right? Remember that? Goods available for sale minus ending inventory is cost of goods sold. And if we're under the periodic system, let's just say, then we would go count our inventory, plug that number in, and then that would give us cost of goods sold. So let's just say we had, here was our number, 6,000. That was our number. And if our ending inventory was supposed to be 3,600, this would be, if it was right, then our cost of goods sold is 2,400, right? Are y'all following me there? Okay. But now, what if our ending inventory is understated? What if our ending inventory was understated? What would this number be? Instead of 3,600, what are we talking about? We didn't count some stuff, right? So what, give me a number, Jeremy. What would it be, for instance? 3,000. Okay. So instead of 3,600, it's 3,000. Then what happens to cost of goods sold? It's now 3,000. Okay, so if ending inventory is understated, this is my little symbol. See, this one's understated. Then cost of goods sold is what? Understated or overstated? Overstated. Do you see that? It moves in the opposite direction. Cost errors in ending inventory make errors in cost of goods sold in the opposite direction. Okay, so look at this. Just look at ending inventory over there. It says understated by it. Now move with the little arrow over to cost of goods sold. It says overstated, right? So we're saying understated here makes overstated there. This is the way to think about it, going with the little arrows on the chart here. Watch the flow, okay? Now, cost of goods sold affects net income, right? Moving down with the arrow. How does cost of goods sold affect net income? The same way or an inverse relationship? Inverse or direct? What does inverse mean? Opposite or direct? Did y'all see the question? If cost of goods sold is overstated, net income is understated. Is that inverse? Yes. Okay. So net income is inverse to cost of goods sold, right? Because how do we figure net income? Sales minus cost of goods sold is net income. So we could do that little subtraction thing. So in these kind of problems, if you get confused, plug the numbers in like this. Plug the numbers in. Here's how it should be. And what do we do, Jeremy? We just made them up, right? Just make up some numbers and plug them in and see what happens if you get confused on it, okay? So make up numbers for sales and cost of goods sold and net income and all of that. But go in this pattern here, from inventory to cost of goods sold, down to net income. Where are we going after net income? Angela? Where's our error taking us? Retained earnings. Why is that? Net income affects retained earnings. Is it a direct relationship? Yes. Because we add net income to beginning retained earnings to get ending. We're adding it. See, the deal is with ending inventory, we're subtracting it here. With cost of goods sold, we're also subtracting it. But from net income to retained earnings, we add it. So that's a direct relationship, okay? And then that affects working capital and the current ratio, which I'm not going to kind of go over that. But except to say, what is working capital? Maybe I will go over that on second thought. Working capital. What is working capital? Avery, you got that one? Okay, so it's current assets minus current liabilities. So that's the capital you have to work with as a business. Here's what we have to work with. Why are we just doing current assets? Because those are the ones we really are going to have access to in the little short future, near future, right? So, we want to keep track of this is a very important number. Current assets minus current liabilities. If we have 2,000 in current assets and we have 1,500 in liabilities, then what's our working capital? 500. We only have 500 to work with because we got to use some of it to pay our bills, right? So, and then there's a working capital ratio or a current ratio. See that one down there? That's kind of the same thing on the ratio, current ratio. It's working capital divided by current assets, okay? So my point here, though, is these mistakes in inventory, since inventory is a current asset, a mistake in inventory affects working capital, see? Because current assets minus current liabilities, and it's going to do it. It's not this one that's subtracted. It's this one that's a positive thing. So it's going to be direct, not inverse. See how an understated inventory is understated working capital and understated current ratio. Direct relationship. Okay. All right, so there's stuff on the book to help you work through all of this, which might be a good idea. And the point of this slide is any mistake that you make in the current year, like miscounting your inventory, that's also going to affect the next year in an opposite way. So these incorrect amounts here, they're going to be incorrect in both years because your beginning inventory is used to calculate cost of goods sold. So, but in total, in other words, the error reverses itself in the next year, and then after that it wipes itself out, okay? Then there's no more error because you're on to new inventory numbers. Okay. This is the, what happens if we had a mistake in purchases and inventory. So if we have a mistake, what are we talking about? In purchases and inventory, here and here, both of these. So in other words, we did not record a purchase and we didn't put it in inventory either. This is wiping itself out. Add this, subtract that. Add this mistake, subtract that mistake. It wipes itself out. You see? So, so there's no effect on cost of goods sold. As far as cost of goods sold, there's zero effect. See? No effect on cost of goods sold, which means no effect on net income. But where is there an effect? Our ending inventory is understated. We didn't record ending inventory. And purchases are overstated. So these arrows work together to make cost of goods sold no effect. All right, things to include in cost. I think we're not going to go to that far. I meant to get done with 4, but what I want to do is some problems in the book. All right, so we're going to go to questions on page 450. We're going to see how quick we can do these. This is a shout it out thing, okay? Number 6. Number 6. We're going to, where should these items be on the balance sheet? In other words, are they inventory? Are they our inventory? A, goods out on approval to customers. Is that our stuff or have we sold it? 450. Questions on page 450. 6. Is that our stuff, Avery? Have we sold it? Our choices are we've sold it or we haven't sold it. We sent something out on approval. This is what my grandmother used to do. Send me 5 dresses and I'll see which one I like the best and give you back 4 of them. Have you sold the 5 dresses? No. Okay, no. So which means if we haven't sold it, is it in inventory? Yes, those are only 2 choices, okay? Sold or inventory. All right, goods in transit that were purchased FOB destination. All right, so now, who are we in this whole thing? Goods in transit purchased FOB destination. Who are we? Purchase the goods? Who's purchasing the goods here? Walmart's purchasing the goods. Okay, so goods in transit, FOB destination. Whose goods are they? Are they Walmart? Okay, this is us. We're us here. Do you see how it gets confusing? This is us purchasing the goods. All right. FOB destination. When are they ours? When they get to us. So they're not ours yet, right? That's an X. They don't go on our income statement, on our balance sheet. All right, is this an inventory? Land held by a realty firm for sale. We're a realty firm. We're holding land for sale. What they want to know is this land or is this inventory? We're a realty firm. That's the clue. We're holding it for sale. What's our line of business? Selling land, apparently. So this goes in inventory, okay? If our line of business is selling land, it's going to go in inventory. If our line of business is selling shoes, where does this go? Land held for sale by a realty firm. It doesn't go in land because we're not using it in our line of business. It goes in other assets, okay? So what kind of company you are determines where these assets go. All right, raw materials, where do those things go? Inventory or not? Raw materials. Inventory. Goods received on consignment. Inventory or not? Not. Manufacturing supplies. Inventory or not? Inventory. Okay. All right. That was a shouted out. Now we're going to do another shouted out thing, and that's on page 452. Page 452, number 1. Okay, so some of these might be a repeat. Goods out on consignment at another company's store. Is that inventory? Yes. Because we put the goods out on consignment, right? Got to figure out who we are. So that's inventory. Goods sold on an installment basis where we can estimate bad debts. Is that inventory or is it sold? Sold on an installment basis and we can estimate bad debts. So they're sold and it goes in cost of goods sold, right? Because we can sell it when we can estimate the bad debts. All right, number 3, goods purchased FOB shipping point. Are those our goods? Goods purchased FOB, yes. So that's an inventory. Goods purchased FOB destination that are in transit. Are those our goods? No, so they don't go on our balance sheet. They don't go anywhere on our statements. Number 5, goods sold to another company where we've signed an agreement to repurchase. Is that a sale yet? I don't know, I must have missed that thing. Goods sold to another company, it's not a sale yet because there's a repurchase agreement, right? So at a set price. So that, what is it then? If it's not a sale, it's in inventory, still in inventory. So that's inventory. Number 6, goods sold where large returns are predictable. Is that a sale yet? Yes. So it goes to cost of goods sold. All right, goods sold FOB shipping point that are in transit. Goods sold FOB shipping point, this is us, that are in transit. Are those our goods? No, so they go to cost of goods sold. Okay, so do you see where that works, how this works? This one we haven't gotten yet to. Freight charges on goods purchased. It does go under inventory. We have not gotten to that yet. But there's a slide that says that freight is included in purchases. Well, I guess we haven't gotten to it yet. All right, interest expense. Interest expense on manufactured inventories. No, we don't add interest expense to inventory expense. So that goes into interest expense. Cost incurred to advertise goods held for sale. Do we include that in inventory? Advertising cost? No. So it goes in advertising cost. Materials on hand not yet placed into production. Is that part of inventory? Yes. What do we call that? Raw materials inventory, right? All right, we're not going to go through the rest of those. But the ones that are inventory, they're 13, 14, 16, and 17. 13, 14, 16, and 17 go into inventory. Okay, so those are those kind of problems. Now, let's look at brief exercise 3 on 451. Brief exercise 3 on 451. We're going to be using this little formula again. Well, actually, no, we're not. We're not going to use that formula. In this problem, these guys took a physical inventory and they counted the goods and they said that we have $200,000 worth of goods. Per count, we had 200,000, okay? And then not included in the inventory were these 3 things, and they list them out. Not included in the inventory were 25,000 purchased FOB shipping point, 22,000 sold FOB destination. Well, those 2 things, sorry. What should their inventory have been? So in other words, they just counted the goods that are in the little warehouse, but they didn't include the goods on the truck. Which ones of those should they have included? All right, y'all get to look at that for a second. Which ones of those should they have included in inventory? So what we want to know is what is the right amount of inventory? All right, so going on the third one, not included in the count were 25,000 purchased FOB shipping point. Is that our inventory, Angela? No. Well, I mean, not because of the fact it's purchased, but because of the fact that it was purchased FOB. We could purchase it FOB shipping point or FOB destination. So is that our stuff if we purchased it FOB shipping point? Okay, this is us. Here we are right here. We're guessing, right? Yeah, you're guessing, right? Okay, so we're purchasing it like this. It's purchased FOB shipping point. Where is the shipping point? Here. When it was shipped, it became ours. Okay? When it was shipped, it became ours, so it goes in our inventory. So we need to add that number, 25,000. Okay. The two key things are determine who you are, which one of the little houses you are, and then determine the shipping point or the destination to determine when it changes hands, okay? So, Brett, you have this one, okay? All right, we had 22,000 of goods sold for 300,000 FOB destination. Which one of these guys are we? The left. 30,000, yeah. All right, this is us. We sold some stuff, put it on the truck, and we sold it FOB destination. Is it our stuff or no? It's ours still until it gets to the destination. All right, so does this make sense? There's 4 scenarios. Oh yeah, plus 25 and 22. I'm sorry, I said the wrong thing. Okay, yeah, the 22. All right, so the whole thing down here is 247. This is per the financial statements amount. So in all of these type situations, you should start out with the per count number and add and subtract things until you get to the per financial statement number. They're saying what amount should be reported. So start with per count, add and subtract things to get to the per reported. Okay, so we're going to do another one like that. I think. I was kind of thinking we're doing another one like that. Oh yeah, exercise 2 on page 452. Exercise 2. All right, in your audit of this company, you find that they had a merchandise with a cost of $441. So per their count was $441, right? And then there's a bunch of items that they didn't include in inventory. There's 5 items. Okay, so Brett and Angela don't have to do these. But we're just going to do like this. You're going to do number 1 and number 2 and number 3 and number 4. And Jonathan, you're doing number 5, okay? And Angela, you can do them all, right? So just be ready to tell me yours when we get there. The question is, should we add it into inventory? All right, Jeremy, you have yours, right? Okay. All right, so we had some merchandise which we are holding. We are holding merchandise on consignment. Is that our stuff? We're holding it on consignment. We have it in our house on consignment. Like I put my soap at the soap place, remember? Whose soap is that? My soap. So the answer is no, right? The company did not own my soap. Okay, so number 1, we do nothing. All right, number 2, merchandise costing $38,000 was shipped by us, FOB destination. Is that our stuff? What, yeah. We shipped the stuff, but it doesn't change hands until the destination. So we have to add this in, plus 38 for number 2. All right, for number 3, Jillian, Merchandise costing $46,000. We shipped some stuff, FOB shipping point. Is that ours? No. Okay, so number 3 is no. Number 4, merchandise costing $83,000 was shipped by a vendor to us. FOB shipping point. Destination. FOB destination was shipped to us. It's not ours yet. Number 4 is not ours.
But it said it was received.
It was received
After December 31st.
on January 4th.
You do it before December 31st.
Yeah.
So then, after that, though, then you would.
Right. And when it gets there, it's ours. But on December 31st, no.
Oh,
Okay, so number 5, merchandise costing $51,000 was shipped by a vendor, FOB shipping point. Is that ours? Yes. Okay. So the reason I like this problem is it gives you every single possibility. There's 4 possibilities. We can be the purchaser or we can be the seller. It can be FOB shipping point, FOB destination, which makes 4 possibilities. Yes.
Real quick, just for number 2, I didn't understand why we added that in.
Okay. We shipped it.
Shipped by Olivia?
Yeah, by Olivia, that's us.
Oh, that is us.
Jose Olivia. Yeah,
Okay.
that's us. We shipped it FOB destination,
So then
so
why-
it's still ours. All right, whichever one. What other one?
Why is number 1 not our inventory? It says 61,000, which is held by Olivia.
It's, okay, we are holding some stuff on consignment. Somebody brought us soap, 61,000 of soap
Okay.
on consignment.
Okay.
Yeah, yeah. Okay? So,
Okay, I got it.
see how confusing those little 4 situations are?
Sometimes it's confusing to know who you are.
That's right. That's the main thing. Who are we? Yeah. Okay. All right. So that's good, and we'll see y'all Wednesday. Will we? No, we won't. Monday. Have a good weekend, in other words.